Artificial intelligence is impacting most of our lives on a daily basis. Take, for example, the use of virtual assistants like Alexa and Siri, or the image recognition in our phones for face unlock, and even in something so simple as the product recommendations on Amazon. But the technology has grown exponentially in the past year, thanks in part to ChatGPT and large language models, where these bots require massive amounts of computing power in the form of GPUs. This demand is what caused Nvidia's stock to climb nearly 200% over the past year. And that's why I plan to cover the top high-growth AI ETF or exchange-traded funds. And these are going to be unique from my prior videos because I'll be looking at the technology adoption lifecycle. I'll lay out the top ETF to take advantage of the most growth throughout that entire cycle. And unlike my prior videos, I will include some of the leveraged ETFs since some of my viewers have been requesting it. My goal is to provide some unique offerings that many of you may not have seen before, and I'll try to include something for every type of investor. When we look at this chart outlining the adoption lifecycle of mobile internet, it had three main phases over 6 years. The first phase is the semiconductors in the gold color, which represents the foundation. This would be companies like Nvidia, Micron, Intel, and AMD. Then the next phase is in green with the buildup in the infrastructure. This could be companies like Apple, Amazon, and Meta. And the last phase to truly ramp up is in applications. This may be in the form of software and services like OpenAI, Palantir, and Microsoft. Just keep in mind that most of these companies will not live in just one phase, as they will overlap a great deal. If this chart is any indicator for AI growth, then semiconductors are the tip of the spear and will continue to grow for several years to come. And this would also indicate that companies that may be part of the phase 2 and phase 3 of the AI growth cycle, well, they have years before they begin to see meaningful growth, which makes those companies especially attractive to be investing in today. And as a quick reminder, the AI boom is expected to have an annual growth rate of 36% a year over the next 8 years. To put that into context, if you are under the age of 50 and you maxed out your Roth IRA at $7,000 a year for the next 8 years with an annual growth rate of 36% a year, it would be worth $283,000 at the end of those 8 years. Tax-free. Now, I realize that the chances of hitting the right investments to garner 36% a year, well, it's pretty darn difficult. But that's why I'm making this video, to cover the best ETF across the technology adoption lifecycle so we can all ride that wave together. Let's begin with the first ETFs ramping up at the beginning of the AI growth cycle with a focus on semiconductors. And that first ETF is the VanEck Semiconductor ETF with the symbol SMH, where it has the strategy of holding the top 26 companies involved in semiconductor production and equipment. And it should be no surprise that Nvidia makes up the most weight within this fund. And it has all the key players like Taiwan Semiconductor, Broadcom, and Qualcomm that you would expect. And keep in mind that semiconductors are the first phase in the growth cycle, and they should continue their growth for several years. In fact, I remember a few months back when I said that Nvidia was still worth buying at $800, and some viewers thought that was crazy talk. Well, it's now at nearly $1,200, and some analysts are projecting it to land at around $1,500 at the end of the year. My point is, there's still room. And when we look at Nvidia's recent quarterly results, their data center business makes up over $10 billion in sales in Q2, and it's up over 171% year over year. But the clincher is that their net income is up over 800%. This means that their most profitable part of their business, well, it happens to be growing exponentially faster than the others, which is just like their hardware, where their new Blackwell chips are 5 times faster than their previous Hopper. And as you can see on this chart, this level of growth in 8 years, well, it surpassed even the fastest growth that's been seen by Moore's Law. And this level of change is what is allowing for chatbots and large language models to only recently become available. Literally, 8 years ago, the computing systems couldn't handle the requirements to build the chatbot models that we have today. The hardware and semiconductors, well, they are the foundation for laying the groundwork for the AI growth lifecycle. But in getting back to the SMH fund, the performance year to date is fantastic at 38%. And the 1, 3, and 5-year annualized returns, well, they're also stellar. So when looking at that 5-year at 38.9%, that means that the average annualized returns were 38.9% every year over those 5 years. As a baseline of looking at VOO, which is an index to the S&P 500, its 5-year annualized return is 15.9%, which is great by every mean, but it's nowhere close to 38% that you're seeing from the SMH fund. And when we look at some of the technicals of SMH, The volume is relatively high for good liquidity, and the expense ratio is decent at 0.35%. Overall, this has been one of my favorite funds over the past 10 years, and I believe that the AI boom is going to give me another great 10 years of growth. But what if you don't want to wait 10 years for that kind of growth? Another option that pays 7 to 9% a month on invested capital comes from having your own business. That's where today's sponsor, Limits Express, comes into play. They work as business managers to create and manage an Amazon store just for you, where they buy and sell national branded products using your capital and business. They do all the heavy lifting and the day-to-day work. They don't get paid unless your Amazon business makes a profit. In full transparency, I have invested with Limits Express to simply vet them out and also to verify their process. My first 2 full months of sales came in at just over $12,000 with nearly a $1,200 profit. So that's a margin of 9%. I admit that the process starts a little bit slow because you need to get approvals to sell the brands and also the categories on Amazon itself. So if you're interested in learning more, I'll have a link down in the description so that you can speak directly with Kyle, which happens to be one of the co-founders. You can also check out their website down in the links below. And please keep in mind that all investments carry some level of risk, and this is not a personal recommendation. Now on to the next fund of ProShares Ultra Semiconductors with the ticker symbol USD, where the strategy is to seek daily results resulting to 2 times the daily performance of the Dow Jones Semiconductors Index. This happens to be a leveraged fund that gives the investors 2 times the gains, but also 2 times the losses against the index. And some of the common uses for a leveraged fund is to seek out magnified gains and exposure to growth for less cash. Most every leveraged fund that's out there will overtly state on their website that they're only meant for short-term holding. But many of the viewers have commented how they've actually been using leveraged ETFs to make up a lot of lost ground within their investments. However, I merely want to state that a person should be cautious and watch these types of funds very closely. When we look at the holdings for USD, it is similar to the prior ETF of SMH, but it has about 10 more holdings. And the part that most of you are interested in is the performance, where the year-to-date is over 127%. And taking it even further, the annualized 1, 3, and 5 year are kind of bonkers. If you had invested $10,000 and had an annualized return of 72% over the past 5 years, that would be worth over $150,000. Now let's look at the technicals, where the volume is quite a bit less than the prior ETF, so the liquidity is lower if you need to sell it in a pinch. The kicker is that this expense ratio is at 0.95%, and with a highly managed fund, the expenses will tend to be higher, which is what we expect. Now, I do want to call it the beta being a 3.21, which, in my opinion, is wildly high. And as a quick reminder, the beta is a measure of the volatility compared to the market. We would expect a leveraged ETF to have a very high beta. Because leveraged funds carry a lot more risk, I want to overtly state that I am not recommending any fund, but I just want to provide the facts for all of you to make the best decisions for yourself. Moving on to the next fund of Clockwise Core Equity and Innovative ETF with the symbol TIME or time, where the strategy is to invest in companies meant to save people time, which relates to innovation and AI, which you can see when looking at the top holdings, where it is a mix of companies like Nvidia, Spotify, Apple, and Meta. But an area that is different from most funds is that they have a 10% holding of T-bills or treasuries, which is more of a guaranteed return, and it creates some regular revenue. Another way the fund generates added revenue is from writing call options against their holdings. And this is why they have an enormous dividend yield of 16.5%. And just like other heavily managed funds, it has a high expense ratio of 1%. An item to watch out for is that the trading volume is a bit low, so the liquidity is higher risk than all the others. And when we look at the performance, the fund hasn't been around for very long, but the year-to-date is over 25%, which is pretty solid, and the full 1 year is over 46%. The fund happens to be set up for decent success, where it does capitalize on the high-growth AI companies, but they also have those call options that are generating added income along with the treasuries, giving it a very high dividend, if that's something that's important to you. Overall, this ETF checks the box for being a new entrant that you may not have heard of, and it does scratch that itch for those of you that are looking for high dividends. The next ETF today is the Bank of Montreal Microsectors FANG Index 3X Leveraged Fund with the symbol FNGU, where the strategy is to hold equally weighted 10 top stocks that are the leaders in AI, where it is leveraged 3 times over. And those top holdings, well, they include some of the companies that are mostly in phases 2 and 3 of the growth lifecycle that I mentioned at the beginning of this video. So they do have a lot of room for growth within AI. And when we look at the performance year to date, it is doing great at 57%, and the 1 year over 100%, and the 5 year is in an annualized 68%. Now we'll briefly go over the technicals, where the volume is fairly low, but the total invested in the fund is over $4.4 billion. And like other leveraged funds, the expense ratio is high at 0.95%, and the beta is equally high at 3.91. Seriously, these leveraged funds seem bonkers with their returns, but I personally have had a leveraged ETF for over a year, and it has been one of my best performers over that time. You just need to watch out going into any market correction. Me personally, I would want to dump a leveraged fund going into any major market downturn as quick as possible. The next fund is the iShares US Technology ETF with the symbol IYW, where its strategy is to provide exposure to US computer software and hardware companies in the IT sector, where it has over 130 holdings to give it a lot more diversity within technology. And the top holdings are some of the great companies, along with AMD, Salesforce, Adobe, and Oracle. This fund is a broad stroke across the AI growth cycle of companies, and it should produce great results consistently over the next decade. And when we look at the performance, it is respectable at 14% year to date. And the 1, 3, and 5 years, well, they're also much better than the S&P 500. And when we take a look at the technicals, the fund has over $17 billion in assets, where the volume is also decent, and the expense ratio is a little bit above average at 0.4%. Now, I guarantee that I'm going to get a comment where someone will ask why I didn't pick the fund like Vanguard's VGT, where the expense ratio is much lower at 0.1%. And the reason is fairly simple. When looking at the annual performance, the expense ratios have already been taken out of the return at that point. So whatever you see as the total return, it has all the expenses out, and it also has all of the dividends reinvested. As a total return across all timeframes, the IYW outperforms the VGT fund. Now, don't get me wrong, both of these funds are great, but the IYW has at least had a better performance over time. And of course, if any of you want to see all of these funds compared alongside one another, I do have a link in the spreadsheet down in the description below that has nearly 50 AI funds compared to one another. So feel free to check that out. And as always, there is no strings attached, but if you do like the spreadsheets and you like my content, please consider hitting that like button so my content can continue to grow. Thank you so much for watching.